Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this month's LONGWave video, I'd like to discuss stagflation investing. Our current three MATA SII investment themes focus in the short term on COVID-19 opportunities, in the intermediate term the fallout of global recession, and in the longer term stagflation and how to invest in it. Though stagflation is still out of the way, it is time to start preparing with an understanding of what to watch for and what is involved in stagflation investing. As such, I'd like to cover those items listed here. Let's start with some key understandings of what stagflation is and what are the key drivers to watch for. First, what causes stagflation? Stagflation is generally considered cost-push inflation, which occurs when some force or condition increases the costs of production. This is most often caused by a supply-side shock. Example, rising commodity prices such as oil prices in the 70s will cause a rise in business costs, and short-run aggregate supply will shift to the left on a classical demand-supply chart. This causes a higher inflation rate and lower GDP. Today, think global supply chain supply-demand shock. This could also be caused by government policies such as taxes or from purely external factors such as a shortage of natural resources or an act of war. Think a pandemic. Also, when conflicting expansionary and contractionary policies occur, it can slow growth while creating inflation. That's stagflation. When did stagflation last occur? It most recently occurred in the 1970s. If you compare U.S. GDP by year to inflation by year, you find stagflation in the United States occurred during the 1970s. Central bank policy, the abandonment of the gold window, Keynesian economic policy, and market psychology all contributed to this decade of high inflation. Why is stagflation problematic? Stagflation is a term that describes a perfect storm of economic bad news. High unemployment, slow economic growth, high inflation, which leads to businesses lay off employees to save money, which in turn decreases the purchasing power of consumers, which means less consumer spending and even slower economic growth. How do you fight stagflation? There are no easy solutions to stagflation. Monetary policy either tries to reduce the inflation, that is, higher interest rates, or increase economic growth, that is, cut interest rates. It's a catch-22. One historic solution to make economy less vulnerable to stagflation is to reduce the economy's dependency on oil, at least in the 1970s. That was the option. This graphic may make it easier to understand the drivers. Economic growth is represented by GDP, unemployment, reduced corporate earnings and/or reduced aggregate demand, and inflation. The COVID-19 shock has just delivered an historic drop in GDP, an historic level of unemployment, and plummeting profits. We can therefore likely expect historic consequences. The road to stagflation, as we've previously shown in prior videos, is preceded by the consequences of COVID-19, mounting deglobalization, a global recession, possibilities of de-dollarization, and increasing inflation pressures from a number of sources, which we'll talk about in a moment. So when should we expect it to arrive, or maybe more importantly, what should we look for to tell us its progression? We've laid out three roadmaps in previous videos and papers that all show the likely inevitable emergence of stagflation. In the March Under the Lens video entitled The Coming Era of Stagflation, we built this evolving grid that leads to stagnation and stagflation. In 2016, in our 200-page annual thesis paper, we laid out the emerging crisis of trust and its path that leads to economic stagnation. Most recently, in the May Under the Lens video entitled Regime Change, we revisited this particular roadmap. These and other videos and reports all point to these drivers becoming increasingly apparent. Let's look at some current headline news clippings. GDP. Friday, U.S. Q2 GDP crashed by a record 32.9%. On Friday, Eurozone worst GDP contraction in history. We need to not forget that these numbers are assuming economic growth, as reported by GDP, is in fact valid. As we laid out in our extensive 2017 thesis paper, The Illusion of Growth, this just isn't the case. The points we made then have only increased the distortions in economic growth reporting. Let me be more specific. Here is the familiar GDP formula, where C is consumption, G is government, I is investment, and X is net trade of exports less imports. The charade is that increased government debt to fund endless entitlement programs, bailouts, etc., increases G, but wasn't a result of redistribution from taxes that were extracted from productive work. Then increasing amounts of government debt is handed to the public in the form of transfer payments and spent, thereby increasing C, or consumption. I believe minimally this is called double accounting. This distortion is so large and was never considered when the GDP formula was adopted, that a quarter of all U.S. household income that would come from government spending through debt. Forget 40 million people on unemployment with $600 supplements allowing them to make more than they did when they were working. How can that be productive? Additionally, the debt is financed from foreign direct investment, which increases I. How can we believe that we realistically have real productive economic growth? We don't. That's what GDP is supposed to measure. As the chart on the right shows, we have gutted the U.S. middle class, which normally funds a balanced and healthy economy. But I digress here. Here are some unemployment headlines. Friday, continuing jobless claims spike as almost 50% of lost jobs may be gone permanently. Friday, almost 30 million Americans went hungry last week as recovery stalls. Friday, Dunkin' Donuts expects to close 1,150 global locations. I thought they were a drive-through pickup service that at least had a chance during the COVID-19 lockdowns, because it wasn't a restaurant that were all permanently closed. Meanwhile, we have 2 million restaurants that are expected to never reopen after the lockdowns end. Some earnings and demand pull headlines. Friday, dying restaurants are rushing to liquidate assets on Facebook Marketplace. Friday, Vegas recovery road could take 3 years. Friday, it will take years for passenger numbers to fully recover, etc., etc. The inflation headlines are more and more warning of inflation. Sunday, Morgan Stanley says brace for a spike in inflation as Congress is now in the money supply driver's seat. I'll talk more about that later. Wednesday, the Fed is expected to make a major commitment to ramping up inflation soon. Pardon? This and others are a result of Chairman Powell talking about letting inflation exceed 2% with less focused attention being given to getting ahead of the recovery. This suggests that the Fed now fully understands that the only way to handle the massive debt bubble is to inflate it away, and savers and pensioners be damned, and frankly the currency be damned eventually. This is how I currently view what is happening with inflation. Inflation has been and will continue to come in ever-increasing sized waves. First, it was price inflation, which was forced to be hidden. You see that through a ridiculous CPI number, starting in the late 80s with statistical games employing methods such as substitution, hedonics, imputation, etc. And we did numbers of videos back 8 or 9 years ago on all of this sort of thing and how it was occurring. Then it was service inflation, evident with service costs exploding in the form of health care, college tuitions, daycare, housing rentals, and more. More recently, since the 2008 financial crisis, it has been asset inflation in the stock market, bond market, and the financial markets overall. Next will be inflation as a direct result of monetization of debt in the form of MMT or helicopter money and other various forms of advanced financial repression, or what is technically referred to as macroprudential policies. On the downside of each wave, we have experienced various forms of deflation drivers, shown here, that last for a period of time before the next inflation wave occurs and takes us even higher on inflation levels. Most of the down waves are due to globalization. It all explodes with hyperinflation when the US dollar and fiat currencies are finally out of runway. The coming wave, in my estimation, will see inflation driven by new and less expected sources. Just three of these, include government passing on their costs as effectively, I'll call, taxes. The most obvious will be, in fact, taxes. Very significant rise in federal, state, and local taxes. federal and state income taxes, state sales taxes, local property taxes, and then all of the above using increasing licenses, fees, tolls, surcharges, etc. It may be even larger, will be impairment cost pass-through. This will be surcharges or special charges for COVID-19 expenses incurred by companies and service providers. Lost rent and mortgage payments will have to be made up despite government moratoriums. It will probably take the form of major price increases, but one way or the other, all these costs must be passed on to the consumer. What I believe, even bigger, is something that maybe we could refer to as policy cost tax. We can soon expect surcharges or special charges by government agencies for COVID-19 policy implementation costs. They will have no choice but to pass costs on to companies and consumers. Companies will in turn pass them on to the consumer. In the end, the U.S. taxpayer is going to pay for the pandemic. The final, I think the biggest, is going to be a weak dollar import tax. The payment for the pandemic will also come in the form of a weaker dollar from monetization and therefore rising import costs for goods. For 40 years, the costs of import goods have been deflationary. Soon they will be inflationary through a steadily weakening dollar. It's time to think about what investments worked in the last period of stagflation. Historically, the categories of stocks which offer the greatest chance of gains during stagflation include healthcare, food, energy, utilities. Historically, the continued global demand for energy often means that foreign nations will continue to purchase from global suppliers even if the U.S. domestic economy is faltering. The best place to hide in a stagflation environment would be real estate, commodities like gold and silver, hard assets that are stores of value, treasury inflation protected securities will help protect principal as they give investors guaranteed real rate of return regardless of inflation. What about today's environment though? How are these things different and how should our investment thinking be different? Clearly, the sheer size of the numbers of all our drivers is dramatically different and higher. But maybe something else is also bigger, and that is government involvement and control. We'll talk more about that in a moment. But today, Western governments will only ever attempt fiscal austerity as a last resort. We no longer take away the punch bowl when the party gets going. This used to be the role of the Fed. Now they are frankly the liquor pushers to the orgy. The conditions today for both good and bad inflation are now in place. We are presently likely living through another deflation shock, but by 2021, inflation could easily be at least near 4% in the U.S. and most of the developed world by 2021. This projection is primarily based on expectations of a normalization of the velocity of money. Velocity in the U.S. is probably at around 0.8 right now. The lowest recorded number before that was 1.4 in December 2019, which was at the end of a multi-year downward trend. Quantitative easing was an important factor in that shrinking velocity because central banks handed money to savings institutions in return for their treasury securities, and all the savings institutions could do was buy financial assets. They couldn't buy goods and services, so that money couldn't really affect the nominal GDP. You see what was going on here? The money banks are handing out today is going straight to businesses and consumers. They're not spending it right now, but as lockdowns lift, this will have an impact. The velocity will normalize back to around 1.4 sometime next year. Given the money supply we've already seen, that would give you an inflation rate of 4%. Plus, there is no reason velocity should stop at 1.4. It could easily rise above 1.7 again. Additionally, for the last 3 decades, China was a major source of deflation. We are at the beginning of a new Cold War with China, which means higher prices for many things if that occurs. The investment consequences are likely to be European inflation-linked bonds are pretty attractive now because they are pricing in such low levels of inflation. Gold is obviously a go-to asset for the long term. In the next couple of years, equities will probably do well. A bit more inflation and more nominal growth is a good environment for equities. That is, as long as the inflation isn't at but Japanese equities look appealing since the BOJ is buying the market. Whatever you do, don't buy government bonds under any conditions. Value is in companies that can sustain, in my estimation, free cash flow. Real wealth is an asset that can do this, precisely this. So if you want to be long, you want companies that pay out the cash, companies with higher non-US dollar denominated earnings, possibly within a CFS basket structure, and pay out dividends where you hedge the stock price and have an offsetting covered call in place. If you want to short, companies that borrow to fund dividends are a problem and have major problems. I mentioned earlier increased government involvement and control. Central banks have become irrelevant as governments have taken control of the money supply. What will be the role of the central banker? They will be sidelined. They will become more a regulatory than a monetary organization. Inflation over the next 10 years is likely to range between 4 and 8%. The sweet spot for equities is inflation rising to approximately 4%. You exit when it's above that. You will need to learn how to deal with inflation, government interference, and capital controls. Markets used to track GDP, and policy was adjusted to suit. Then, as shown here, GDP tracked money supply, but that's no longer the case. Now, markets track money supply, the global money supply proxy specifically. Now, policy is about increasing the wealth effects. We've had a massive shift in policy formulation. The first thing to realize is that government policies now control the supply of money, not the independence of the Federal Reserve. MMT or helicopter money, whatever you want to call it, is a game changer. Appreciate what has just happened. The control of the supply of money has permanently left the hands of central bankers, a silent revolution. As a result, the supply of money will now be set for the foreseeable future by democratically elected politicians seeking re-election. It is time to embrace the silent revolution and the return of inflation long before such permanency is confirmed. It will be governments who will make sure policies of financial repression are successfully implemented via regulation and dictated monetary policy. It will be governments who will act to stop bond yields from going up. They'll force their domestic savings institutions to buy government bonds to keep yields down. My final point in summary of this is that stagflation investing is going to be more about the return of inflation-adjusted capital versus actually the return on capital during this era. As I always remind you in these videos, remember politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with a relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. We're in a different era. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2020 turn out to be an outstanding investment year for you and your family. I sincerely thank you for listening.